Good morning, good afternoon, or good evening, and thanks for joining us for this webinar on stablecoins in capital markets. My name is Gabriel Carlsen, Senior Director at ICMA, and I'm delighted to be joined today by Ankur Prakash, Head of Digital and Strategic Initiatives for Global Banking at Standard Chartered, Sebastian van Kampenhout, Director, Innovation and Digital Assets and Tokenized Cash Lead at Euroclear, and my colleague, Francisco Parenti, Associate Director in our team. And it's great to see so many participants online. Stablecoins sparked a lot of interest in the early days of crypto or decentralized finance, but in recent years, increasingly so in capital markets. At the same time, it is a topic that has also prompted scrutiny by regulators and market participants in traditional finance. With the advent of dedicated frameworks, stablecoins are set to become a permanent fixture in financial services across the globe. In light of ICMA's mission to promote well-functioning cross-border capital markets, which are essential to fund sustainable economic growth, one of the key questions for us is what the implications of stablecoins are for global bond markets. We have started to explore this question, and there are two recent publications I would like to draw your attention to. The Guardian Fixed Income Framework, which includes a delivery versus payment settlement guide for DLT-based debt securities. This includes an overview of service providers, but also an assessment of wholesale CBDC, tokenized bank liabilities, and regulated stablecoins as settlement assets. The guide was developed by the Guardian Fixed Income Workstream, led by ICMA, and published as an addendum by the Monetary Authority of Singapore during Singapore FinTech Festival in November last year. There is also an ICMA paper on stablecoins, which was published in January. Today's webinar is designed to take a deep dive into stablecoins in a capital markets context. Francisco Parenti will walk us through the key findings of the ICMA stablecoin paper that he authored by way of introduction. We will then discuss the potential of stablecoins in capital markets, including both opportunities and challenges against the backdrop of an evolving regulatory landscape. Today's webinar is designed to be interactive, so please use the Q&A function to submit your questions. And given that stablecoins is a broad topic, to get a better understanding of your knowledge of stablecoins and ensure our webinar is tailored accordingly, we will launch a brief poll. The question here is, how familiar are you with stablecoins? So this should appear on screen very shortly, and we will give it 30 seconds or so for your responses.
We will launch the results now.
Okay, great to see. So there seems fairly split between each category, between very familiar on the one hand, and not at all. And then most participants, if I look at this here, 58% are slightly familiar, which is helpful for us. So with this, I'm pleased to turn over to Francisco.
Many thanks, Gabriel, and thank you for also walking us through the agenda already and through the initial introduction. Now, as Gabriel said, I'd like to briefly guide you through specifically what stablecoins are, to which type we will refer to in this webinar, to then pass on to our conversation with Ankur and Sebastian. Now, stablecoins are essentially digital representations of value that are designed to maintain said value via reference to an asset or a basket of assets, which can be comprised of fiat currencies, which are dollars, euros, or pounds, or other equivalents, or alternatively, to commodities such as gold. For the purpose of this webinar, we will discuss primarily stablecoins which reference fiat currencies. Now, as a preemptive addition, while algorithmic stablecoins also exist, they have fallen mostly out of favor outside of crypto trading spaces, with their issuance effectively banned by many jurisdictions, especially due to many failures, most famously the Luna Terra crash of 2022. Now, within the capital markets, when discussing the potential use of stablecoins, we are referring only to regulated stablecoins, which are those that follow the applicable regulation of the relevant jurisdictions under which they are issued. This is an important distinction, as most relevant jurisdictions have already developed and put in place relevant regulatory frameworks, which, while they have differing levels of coverage or of convergence and divergence, they do tend to get some of the basics like one-to-one backing reserve assets and requirements for highly liquid assets to be held and for the prohibition of interest, as an example. Some of these are those that are shown on screen here, which are the EU's MiCA, approved in 2023, the Hong Kong's Stablecoin Ordinance, approved last year, 2025, Japan's Amendment Payment Services Act from 2022, and the USA's Genius Act from last year, 2025. Now, with this brief background, it is my pleasure to finally introduce Ankur and Sebastian for a conversation on the potential for stablecoins within the capital markets. As a reminder, as was mentioned previously here, we will have a Q&A section at the end of the webinar, so please submit any questions that you may already have or that come up during a conversation so that we may address them at the end. So, to start it off, Ankur, from a global bank's perspective at Standard Chartered, what general use cases have you identified for stablecoins? Do you foresee that they have the potential to be adopted on a wider scale?
Thank you, Francisco. And welcome to all the audience who have joined live. Greetings and hope you enjoy the session. To your question, Francisco, stablecoins are often discussed as a payment innovation, but from our perspective at Standard Chartered, their real potential may lie in becoming a settlement layer for capital markets. As financial assets themselves become increasingly tokenized, bonds, funds, other real-world assets, a key question becomes as to what settles these transactions on-chain. And stablecoins are emerging as one of the most practical answers because they allow instant, programmable, and potentially global settlement. So with that in mind, the three most relevant use cases that we see emerging are, number one, settlement for tokenized securities through atomic delivery versus payment. Number two, improved collateral mobility across venues and markets. And number three, reduced friction for cross-border capital flows. That said, the market remains very early. The global stablecoin market is estimated at roughly US $300 to $325 billion today, while the global bond market itself exceeds US $130 trillion. So it is still very much an early stage, but also shows that there is a long way to go.
Thank you, Ankur. That's very clear, and it certainly shows there's a lot of interest and definitely potential here. Now, Sebastian, from Euroclear's perspective, what potential do you see for the use of stablecoins in capital markets from a market infrastructure firm's perspective? In what ways have you explored their use?
So, well, we see, of course, a lot of potential with stablecoins. So, as Ankur mentioned, we have a market capitalization of, there is a market capitalization of 300 billion today of stablecoins. So this is a huge increase compared to 5 years ago. And many analyses have predicted that we should turn around $2 to $4 trillion of market cap by 2030. So that is an exponential increase that is expecting us. For post-trade services, that could actually translate in also a huge increase. So Citi was recently estimating that we could reach settlement volumes of 10% on post-trade services using tokenized cash. So tokenized cash, that is CBDC, that is tokenized deposits, and that is stablecoins together. So in 2030, it could be 10% of the settlement done by market infrastructure like ourselves in the tokenized way. So yes, the potential is huge. So the first use case that we are investigating is, of course, the settlement using stablecoin, because, well, today we are settling with traditional money, be it central bank money or commercial bank money. When it comes to digital assets, digital securities, we need to have a digital form of the cash. And that is when we will be most likely using stablecoins as a form of commercial bank money. We will remain in having a two-tiered model with central bank money that is the preferred means of settlement, because the central banks will want that to remain. But when CBDC is not practicable or available, just like CSDR says, then we will have to use a private means of money, and that is tokenized deposits or stablecoin. So yes, this is the first use case that we are investigating. And of course, it is just like all the digital assets or digital settlement means, it will have a 24/7 availability. It will be programmable, so it will have many advantages that are of interest. Next to that, there are ancillary services that we will be looking at around blockchain, around stablecoins. So that can be the custody of the reserves, obviously, some wallet services, collateral management, treasury services. So there are a lot of things, but let's say that for a settlement house like Euroclear, the settlement services is, of course, the first use case. One thing that you mentioned at the beginning is one very important aspect for any FMI like ourselves is that the stablecoin, to be able to be used by us, will need to be duly regulated and will have to include FMI grade standards. So that is absolutely certain, absolute certainty in terms of legal finality, asset protection, data quality, etc. So that even if you are regulated, that does not mean that you will be sufficiently secured to go in an FMI. So that is something that we will be looking at.
Of course, no, that's very clear. Thank you. And yeah, it's not necessarily because it's regulated that it's up to the standard we necessarily need to see in every way. So that's a great point. Now, Ankur, considering the application that Standard Chartered has and is now exploring, what are some advantages with the use of stablecoins that stand out, if any, when comparing to both other forms of cash on chain and fiat currencies?
Sure. Look, stablecoins versus fiat offer several practical advantages in blockchain-based environments, and Sebastian talked about some of those. If we compare stablecoin versus fiat, three big advantages to my mind. Number one, speed and availability. Fiat settlement through the correspondent banking networks today can take 1 to 3 days, and it is limited to business hours. Stablecoins settle 24/7, near instantaneously, and across borders. Number two, on the cost, and again, cross-border fiat transfers may carry high fees depending on jurisdictions. Stablecoin transactions are significantly cheaper. And number three, and this is probably the most important one from a security settlement perspective, is programmability. Fiat cannot natively execute smart contracts. Stablecoins automate payments, escrow, trade settlements without intermediaries. So those are the main benefits versus fiat. Now, compared to the other forms of digital money, tokenized deposits are typically confined to the bank networks and balance sheets. So they don't move freely across institutions or blockchains like a stablecoin can. Versus the CBDCs, the central bank digital currencies, those are policy driven and as of today remain largely experimental for wholesale use with very limited real world deployment. So I think versus stablecoin, again, Stablecoins have developed faster because they emerged organically to address the immediate liquidity needs in digital ecosystems, and that truly gives them a head start in adoption and infrastructure.
So very interesting. And as you also briefly touched on your answer now, stablecoins bring, at least theoretically, new opportunities for retail and especially institutional investors. In your experience, has that held true, especially in a capital markets context?
Yeah, no, it's a very interesting question, because while stablecoins may reduce the frictions, in particular around payments and cross-border access, but from a capital markets perspective, access is not primarily constrained by the payment rails. So if you look at the capital markets, from my experience, the real constraints are around, one, securities regulation, and number two, the investor eligibility. So while the stablecoins can make settlement more efficient, they don't fundamentally change around who participates in these markets. So capital markets are structurally wholesale. Regulators have been cautious on retail participations for good reasons around investor protection. And if you ask me, in my view, the realistic near-term path is institutional adoption first, and retail access coming in later through regulated intermediaries and diversified risk structures like funds, ETFs, etc.
Perfect. No, thank you. Yeah, it's more of a structural shift in the underlying infrastructure instead of necessarily an approach towards new markets, let's say, in that sense. Now, Sebastian, if we look at some of the limitations when it comes to stablecoin usage, what impact do the regulatory constraints placed by regulators have on their attractiveness when used for settlement?
Well, the regulatory constraints we have today, well, they're not constraints as such. It's actually that it doesn't exist for Euroclear, for CSDs like ourselves. So our main regulation, which is CSDR, was drafted before stablecoins existed. So it's not foreseen today that we can settle in stablecoins. So that makes it practically very complicated, if not impossible. So yes, this is something that will be solved as part of the MIST package that is now being worked on. There is a review of CSDR that is foreseeing the fact that CSDs will be able to settle in stablecoins, or e-money tokens. That is one specific type of stablecoin. And that will be foreseen for CSDs, as I mentioned before, if central bank money is not available or practicable. So that is you will have the primary requirement for wholesale CBDC, which will be made available through Pontes and Appia. But when it comes to CSDR, so yes, there will be the possibility for CSDs to settle in stablecoins. But now that doesn't mean that it will be easy. And why is that? It's also because, well, CSDR will regulate how we can settle with using stablecoins, but the stablecoin itself will be regulated under MiCA. And so you have two separate frameworks that are supposed to be closely aligned. And this is where potentially we see that there could be concerns. We are analyzing this. But to get back with some history, MiCA was drafted in 2002 and validated in 2023. That was kind of the beginning of stablecoins when it really started to grow. You still had DM, so that is the stablecoin of Facebook that was existing, and clearly supervisors, regulators were not very big fans of the stablecoin. So stablecoin was regulated in MiCA in a way that is that incorporates this mindset that we had a few years ago. And clearly, the mindset was not back then to use stablecoin as a settlement asset as part of FMI, large FMIs like CSDs or CCPs or whatever. So this is where potentially you could have tensions between the two regulatory framework, CSDR for the settlement and MiCA for the instrument. So as I mentioned, this is something that we are looking at, and we expect that there could be some barriers there. but we are not here yet because this is as part of the MISP package, and MiCA anyway is not under review. So well.
That's very clear. Thank you. But now, if we're talking a bit about clashing regulations, not necessarily just on a, for example, European level, but we're talking about a global scale, like the capital markets essentially are. When it comes to regulation, the risk of fragmentation still presents itself as one of the greatest for the development of the market, of the stablecoin market. While regulations have landed on some converging points that we previously approached, such as the obligation for issuers to maintain at least one-to-one backing of reserve assets, which are highly liquid and low risk, key points of divergence remain, with regulators moving forward differing priorities for their jurisdictions. With that in mind, how would you like to see regulatory frameworks evolve to support the safe integration of stablecoins?
Well, fragmentation is clearly the enemy of liquidity and efficiency, and fragmentation can come in many ways, and legal fragmentation is one of them. So let's say that European are trying to resolve fragmentation within the EU, but you still have legal fragmentation, and certainly in terms of stablecoin. You mentioned that we have now the US, EU, Singapore, Hong Kong. So many jurisdictions have their own legislation tackling stablecoin. The UK is working on one, and you mentioned that, yes, there are some convergence in some key aspects. So here, for example, every one of them is asking the issuers to be licensed. Everyone is asking for to have a one-on-one high-quality reserve backing. You need independent audits. You need redemption at par within a predefined time frame, full AML, KYC, and sanctions control. So yes, you have concepts that are the same everywhere. However, the details of these concepts are still not the same, and so you have some very major differences. So convergence between these different things would, of course, be something that we like. Euroclear is active in more than 100 countries. We are settling today traditional form of money in more than 50 currencies. So yes, we are, as a global infrastructure, it would make sense, and we would love that it's full convergence. But here, that is my personal point of view. I doubt that it will happen fast. Why? It's mostly because the different jurisdictions have different objectives in the way they are regulating stablecoins. The US today clearly is not in favor of CBDC. That seems clear for several years. And so they are pushing forward the stablecoin for geopolitical reasons. To increase the amount in their treasuries, to have higher reach. So they have an objective of that is partly linked to geopolitics. Europe, we have an objective that is more linked to safety. Historically, stablecoins are not the preferred means of payments in Europe. Maybe that will change, but it's not the case today. And so we are putting forward the safety and also the strategic autonomy. And when you see that 80% of the stablecoin market is today controlled by two US players, Circle and Tether, that's 99% of the stablecoins in circulation are denominated in US dollar. And there, Europe will probably, that's again personal opinion, will probably maybe not want to be fully interoperable with the rest of the world, because this means that they will not be able to challenge this situation, which is clearly not in favor of its strategic autonomy. So yes, there are different perspectives in the way they are looking at things that will make the regulatory convergence quite difficult. So yes, this is something that we would really love to have, but I don't see it coming quite soon.
Yeah, exactly. And I think in an ideal world, of course, full convergence would be perfect, but reality sometimes gets in the way of that. That's in some ways. But thank you. Now, Ankur, as regulators begin to distinguish between tokenized assets and settlement assets, what are the key considerations for integrating stablecoins safely into the capital markets? In your experience, where are the critical gaps?
Yeah, I think, look, the distinction between the asset layer and the settlement layer is one of the most important developments that we are seeing. And regulators are clearly starting to clarify this. Federal Reserve, Securities Exchange Commission earlier this week, for example, made it clear that tokenized securities would remain as securities, but the stable coins that are used for settlement are not. Now, what is still evolving though is how a security transaction is treated when it is settled using a stable coin. That whole package, how would we treat that? Right now, that is not clear yet, and that has implications for capital, for risk treatment, and how the banks like ours can intermediate these flows. Now, beyond that, I think there are three key considerations, and we talked about it just a few minutes back. But first is the alignment with banks' balance sheet and liquidity frameworks. Holding stablecoin is not the same as holding central bank money today, right? I have $100 in US dollars, the fiat currency. I have 100 USDC. Is it treated the same way from a balance sheet perspective? Not so clear yet. Second is the integration with existing market infrastructure. And that is what Sebastian just mentioned, particularly enabling the delivery versus payment between a tokenized security and a stable coin. And this is where it doesn't work. If the existing settlement infrastructure, if it's going to be really hard to scale if that integration with the existing infrastructure doesn't happen. And the third, and I think again the most important one, is institutional adoption, because everything moves where money moves. So this is still where the biggest pools of capital exist for capital markets: the large asset managers, the fund managers, the insurance companies, pension funds, and interoperability is very, very key to avoid that fragmented liquidity. Thank you.
It's very clear, and I think we always end up coming back towards interoperability as a key point, when we're talking about anything to do with digital integration and digitalization of markets. But now, Sebastian, what barriers do you still see for stablecoins to be used for the settlement of capital market transactions? Does this aforementioned lack of interoperability pose a significant problem?
Yes, certainly. So as a barrier, I mentioned regulation, but clearly the second one, if we are moving away from regulation and looking at the technical side of things, yes, the interoperability is clearly one of the biggest technical barrier that we have. So stablecoins is a new form of assets and it has the particularity, just like any digital assets, it can move across different blockchains. The issue is that there is today limited cross-chain composability. So this means that basically you need to make bridges between the different blockchains. And when you are moving one stablecoin from one blockchain to the other, that's inevitably today, because there is no clear interoperability, it requires operational, well, it involves operational and cyber risk, cybersecurity and security risk. So yes, this interoperability between blockchain that is often embedded in the stablecoin is not there yet. To use a clear example that will speak to many and that I've read in a recent report, you have USDC, so that is the Circle stablecoin in US dollar. If you have it on the Ethereum blockchain or if you have it on the Solana blockchain, it will actually be different. One will be different than the other. There is no fungibility between the two. So you need to make it's like if you have a stablecoin on two different accounts in two different jurisdictions, it's very kind of complex. You need to make a transfer between the two, and it involves complexity. So voilà, this lack of interoperability is clearly a problem. So what has been done in the securities markets is to work on standardization and interoperability standards. And we, ICMA, you've done a great work with the bond data taxonomy, for example. Well, Euroclear, we issued a couple of 10 days ago, so now with Clear together with Clearstream and DTCC in partnership with BCG, the DASCP, so that is the digital assets securities control principles. So these are principles to ensure that there is some, to ensure interoperability in the digital assets securities. Most likely, or preferably, there should be some sort of working groups that are being set up to work on such kind of standards for stablecoins. So Euroclear, we are not stablecoin issuer. It's not our job today, but I suppose there are some players who would be who could launch that. So we would be very yeah, that's something that we would like very much need.
Yeah, thank you. Yeah, it's very clear that the need for standards is essential, and it's unmistakable. And as you said, ICMA, we're working hard on that, and other associations and all players in the market to walk towards that way. Now, as a final question to both of you, looking towards the future, what are the priorities that regulators in the market alike should have to foster the safe adoption of stablecoins in capital markets? And let's go maybe to Ankur first.
Name-wise, alphabetic. That is good. Look, for me, Francisco, it comes down to the 3 C's, which we extensively discussed during the last half an hour. Clarity, connectivity, and credibility. Clarity in regulation, connectivity with the existing financial market infrastructure, and credibility, i.e. trust for institutional adoption. The technology is not the problem here. I think the technology is largely there. The next phase is about building those integration layers and building trust.
It's very clear. Thank you. And Sebastian, do you agree? Anything else to add?
Well, I clearly had kind of the same. I did not call it the 3 C's, but it's I have basically the same. So things that we've said. So first, it's the convergence on the core regulatory standards. So as I mentioned, it will never be the same, but let's hope that we get some convergence to make sure that if a token, a stablecoin is regulated in a jurisdiction, institutional players can trust this as being sufficiently in line. The second point is a clear definition of FMA grade stablecoin. So this is what Ankur was mentioning. So clearly, some institutional players need to have really high safety. So that's, I mentioned it at the beginning. It's fine not to have different styles of safety in the stablecoins. They should not all be equal, but at least we need to have to define what is a stablecoin, what requirements must meet a stablecoin that is used by institutional players, like Standard Charters, like ourselves. And then the last point I mentioned before, the interoperability across chain and infrastructure. Interoperability will be key. And for me, that's, again, I repeat it because it's clear. Interoperability is key for liquidity and efficiency of the markets.
Very clear. Thank you. And as I think one key word that I'm hearing here and heard throughout the answer, especially the last few ones, that interoperability is the key in the end. It's the essential part that will probably allow the market to really develop, to really take maybe the next step with adoption, especially of stablecoins. And thank you very much to both of you. I think we had some very insightful answers to some interesting questions. And now I'd like to move along to the Q&A section, where the audience has already given us a good amount of questions that we have in the chat. But if you think of any others, now is your chance. Now is when we'll start looking at them and start answering some of them. But if we want to start I have one interesting question here that maybe to both you, Ankur, and you, Sebastian. Do you see the future of bond markets moving toward tokenized bonds set with stablecoins? And in which context can this happen? Is it still going through, for example, the ICSDs?
Maybe I can just go there first. I do see a clear trend where there is a potential for capital markets to transition into a future where they are settled in stablecoin. It doesn't necessarily mean that the end borrower of capital or the end investor of capital needs to have stable coins in their accounts, although that may happen as well. But for the time being, there is a good chance that people will continue to operate in fiat because that is where the traditional supply chains of money have always been. But the settlement layer moving to stablecoin, I think that is very much a possibility. I think that is something which can bring a lot of efficiencies. We have seen that happening in money market funds, although it is yet to sort of happen at scale, and that is largely because of all the adoption issues we talked about. But having a yield-bearing instrument on chain that is settled in stablecoin is something which I genuinely believe is the future for capital markets.
So yeah, and Sebastian, do you want to also add your perspective?
So yes, at one point in time, yes, we do see some tokenized fixed income bonds settled in stablecoins. So that's very certain. Will it happen outside of the ICSDs? That's to be seen. Well, as I mentioned, stablecoins involve risk, so it's not central bank money, which means that today you have the domestic CSDs who are the normal, let's say normal CSDs who are settling in central bank money. To be able to settle in commercial bank money, you need to be an ICSD because you need to have a commercial bank license, not a banking license, not a commercial bank, a banking license to cover the risks linked to the use of commercial bank to do the settlement. The risk linked to tokenizer to commercial banks money is not exactly the same as the stablecoin, but there is risk in both sides. So today, what they are foreseeing is that you need to have a banking license as a CSD to settle using stablecoins. So yes, most likely the ICSDs will be the chosen one to settle the fixed income using stablecoins. But that can say that anyone can get a banking license and start settling. So today there are two large ICSDs. Today we could have more if other CSDs see an interest in entering that market.
If I may just add to that, from our perspective and what we see talking to investors, again, I think that ICSD route probably is going to be the preferred route because, like we discussed about adoption, the ICSD model has existed for decades. The investors are used to it. The large money is very used to it. And there is always some time that it takes for people to move to a new model. Set up the governance, set up the reporting model, set up the operational machinery to do that. So I would say that the world is already using the ICSDs, and I believe that would be a good way if ICSDs can enable the stablecoin within their workflows.
Well, thank you to both. And yeah, I believe ICSDs still play a very massive role that it's definitely not likely to be replaced anytime soon in the near, medium, maybe even long term. But if we move on to a different question, I see one here that's interesting. We're talking about stablecoins. One of the big talking points that we have now is their pressure on the banking system, right? You have both the move away of deposits away from traditional banks, and also the pressure that they make, for example, towards treasury bills and towards that access to liquidity. And do either of you have a view on the threats? Let's call them on the potential financial stability risks that are brought by stablecoins, and of possible ways to mitigate it as such, if they are threats.
Maybe I can take a stab first. Again, look, I think, and there were reports earlier around the threat of deposit move away from banks, and then what does that mean for credit creation? Because today, banks act as that middle pipe. People deposit money in the bank, and the banks use that to do the lending. So it is sort of that machine that helps in the credit creation. And if there are less deposits or no deposits, then where does the lending happen? One, I do believe that if the banks do not act fast, if they do not keep pace, then certainly that risk is there. But I do see the banks certainly taking a part in that. The regulators, of course, prefer banks to be a part of it, and therefore in jurisdictions, many of jurisdictions, we see banks becoming issuers of stablecoin, right? So the bank issued stablecoin versus a fintech company issuing a stablecoin, again, from a trust perspective, has a different repercussion. We talked about regulated stablecoins, and again, a regulated institution issuing a regulated stablecoin, that again, from a trust perspective, has benefits. So I do think that overall, the banks need to keep pace with the regulation. The banks need to keep pace with the technology. But if they do, then I don't really see that much of a risk per se, because again, a very, very large market in very early stages, and something that certainly requires trust. And that trust is very, very key when it comes to any kind of financial asset. That trust people still have on banks. We all feel more comfortable putting our deposits, our salaries in banks. And I think it will take a long time before that trust moves to institutions that are completely unregulated.
Very clear. Thank you. And Sebastian, any view from your side?
For us, the situation is very different, of course. As a CSD, we don't have customer deposits on our balance sheet, so it's the perspective we have with stablecoins is extremely different. For us, it's just what I mentioned, that we have I think it's 52 different currencies. We are doing settlement in 52 different currencies. Here, stablecoins will just be new types of currencies that are added in the settlements that we can do. So it's just an additional means of payments that we are adding to our portfolio of settlement assets. So we don't see it clearly as a risk to our business, except if it introduces risk in our settlement process. So that's why we will be very careful that the stablecoin itself does not introduce risk in our FMI processes.
Very clear now. Thank you. I think, yeah, risk management and with different technologies definitely has to be maybe the main consideration when I talk about these kinds of adoptions. But now one topic that seems to be growing not only within our webinar, but if you're looking at the broader discussion on stablecoins and their adoption in different parts of the banking system, is them versus tokenized deposits as a somewhat of a competitor, let's say. Especially tokenized deposits are in essence just bank deposits which are then tokenized. They can be yield bearing. They have some key differences to stablecoins. And this may be a more forward-looking question here to both of you. Do you see either of them as being as, let's say, at this point, losing the battle? Or do you see a specific preference going towards tokenized deposits or going towards stablecoins, or they just different possibilities, different settlement assets that can be chosen, that can be used depending on the investor, depending on the situation? How do you see developing? And maybe Sebastian, if you want to start with this one.
Well, here again, similar as my previous question, that will be more something from Ankur. But no, here we are an observer. We will be settling in, as I mentioned, basically it's our clients who are deciding in what form of cash we will be settling. So if they want to settle in CBDC, in tokenized deposit, or in stablecoin, we will offer it if it falls under our possibilities of settlement assets. So here, the difference between the two, if from my observing aspect, so not linked to Euroclear, what I see is that stablecoin has hugely increased over the last few years. So they might have taken some form of lead, at least in terms of market cap. Tokenized deposits is taking some time to start, but it has quite a lot of potential, and it could, in my view, easily catch up if the banks are putting the means to it. But that's just a personal view, because here again, Euroclear, we don't have a view on that.
Thank you. So, Ankur.
Yeah, look, I think early days for both, but like Sebastian said, I think stable coins, because they were natively born on the blockchain infrastructure, and they have a much longer history, right? I think 2012 or 2013 is when the first traces of stablecoin on blockchains emerged. At that time, there was a real use case on chain to have hedging for people who were trading cryptocurrencies. How do you hedge that risk? You had to go off chain, and that was often very difficult. So that was the use case for which the stable coins emerged as like a digital dollar on chain. So they certainly have significantly more presence in the blockchain infrastructure versus tokenized deposits. And therefore, I think they certainly have a lead as of today. Tokenized deposit, again, because they are confined to the bank networks and balance sheets, they don't really move as freely across borders as a stable coin would, right? So a tokenized deposit could have certain, in my mind, wholesale use cases. Especially we see use cases for corporate treasuries who have operations across the world, and they sort of create a network of tokenized deposit with banks clearing each other's deposits across borders, and they could sort of manage their funds, corporate treasury funds, in a more efficient way. And we are part of some of those experiments and discussions on tokenized deposit. But versus stablecoin, I do think that stablecoin potentially has a superior value proposition versus a tokenized deposit.
That's very, very interesting perspective. Thank you. Thank you again. And as we're inching towards the hour, I'd like to thank both Ankur and Sebastian once again for taking part in this webinar, for their very interesting answers. And as we move towards the finish, I'd like to invite my colleague Gabriel Counson once again for some closing remarks. Gabriel.
Well, thank you, Ankur, Sebastian, and Francisco, for this insightful conversation. It was great to have your perspectives, both from a bank and an international market infrastructure, on this topic, which is multifaceted indeed. But also, thank you to the audience for these interesting questions, which I think highlight the interest in the topic of stablecoins and cash on chain more broadly. A couple of points I would like to add in response to some of the questions from our audience briefly. On the question how stablecoins are used for the settlement of tokenized or DLT-based bonds, at ICMA, we monitor these developments very closely, and we maintain a fintech tracker where we post all the different announcements, press releases, and looking at this, there are in fact very few transactions to date that have been settled using stablecoins. But This may change in the future, as we have heard. Also questions on how to compare stablecoins, tokenized as deposit and CBDC. And just to reiterate, some of those aspects are indeed discussed in more depth in the DVP settlement guide under the Guardian fixed income framework. In particular, questions around eligibility of participants, nature of credit risk, liquidity risk, whether interest bearing, comparing kind of side by side wholesale CBDC, tokenized bank liabilities, and regulated stablecoins. So I would encourage you to look at this publication to explore further. Now, as we only have a few minutes left, now coming to the end of the webinar, I would just like to highlight a few final points. So reflecting on our conversation, as well as ICMA's engagement on DLT and tokenization in international capital markets. And we heard from our panelists already that the importance of having a form of cash on chain and cash on chain or tokenized money has long been considered a missing piece in the puzzle to unlock the benefits of tokenization. So indeed, when we look ahead, the proliferation of new forms of digital money is expected to drive growth of tokenization in bond markets, but also in other asset classes. However, there's another important aspect to consider here, and this is where the adoption of stablecoins accelerates and issuers of US dollar denominated stablecoins increase their holdings of US Treasury bills. One of the key questions is what the ramifications are for Treasury markets, but also for fixed income markets more broadly. There's a paper published by Professor Yadav and Professor Malone that delves into this question, which is well worth a read. Now, from ICMA's perspective, fostering the development of digital bond markets, supporting market stability and consistency are core objectives, with a particular focus here on the safe and secure adoption, innovative and transformational technologies, as well as the promotion and implementation of standards and best practice where relevant across the full spectrum of market stakeholders. So accordingly, our focus is on DLT readiness of global bond markets through webinars like today, or the webinar with the Hong Kong Monetary Authority on digital green bonds and the bond data taxonomy in February, but also guidance provided by ICMA's DLT Bonds Working Group here in the form of the DLT Bonds Reference Guide as one example. Custody of DLT-based securities is another key topic, building on the report on lessons learned from custody arrangements for DLT-based securities, which was published under the Guardian Fixed Income Framework 1.1 last year. But clearly, repo and tokenized collateral, digital money is equally important. In particular, within a markets context, we've heard from our panelists about the different use cases of stablecoins. And back in 2024, we published a digital assets annex for the Global Master Repurchase Agreement, which is designed to help market participants document repo transactions that involve digital cash, digital securities, including tokenized traditional securities, as well as asset-backed digital assets. Then, importantly, collaboration with regulators is key to support market stability and consistency through, as mentioned, safe and secure adoption of innovative and transformational technologies. And it is something that we continue to do. And as already alluded to, the importance of common standards when it comes to interoperability. A key initiative here for ICMA is the bond data taxonomy, with the release of the version 2.0 coming soon, as well as the ongoing integration in partnership with SWIFT to integrate the bond data taxonomy into ISO 20022 to support harmonization and interoperability. So lastly, looking ahead, ICMA will be holding its 58th AGM conference in London at the end of May from the 27th to the 29th, which will bring together over 100 stakeholders across 1,000, not 100, over 1,000 stakeholders across the value chain of international capital markets. So it's ICMA's flagship gathering to discuss key themes in global markets, policy and innovation. So with that, thank you again for joining us today. A recording of the webinar and the slide deck will be made available on ICMA's website, and all registered participants who have joined today, or those who were not able to join today, will receive an email. Thank you and bye for now.